Oil just lost its backbone. The IEA has projected a new supply surge that could send Brent to the mid 50s, potentially even $55 a barrel. And when crude wobbles, Canada, of all places, feels it first. Now, the loonie is no longer relying on crude oil. Instead, it is waiting patiently for the Bank of Canada's signal. For the average household, that means cheaper gas at the pump, yes, but at the cost of lower wages in places like Alberta and overall loonie weakness across the board. For investors, this is a clear signal that commodities are breaking its tie to the loonie, and policy is now pulling harder than energy ever did. In this video, we'll break down what the IEA's surplus forecast really means for oil spreads and why the loonie is tied closer to the Bank of Canada than it ever was to crude oil. Let's get into it. So right off the rip, guys, earlier this week and into last week, the IEA came out with this surplus forecast indicating that there's going to be an insane amount of inventory of barrels growing into the year end. And so basic supply demand dynamics, when there's an oversupply, that is usually bearish on price, meaning sellers of oil are willing to sell for cheaper in order for them to release their supply. And so going into the year end, we can expect weaker oil prices from here until December 2025. Just a quick visual. Here is on the left the relative supply versus the relative demand. Now you can see supply is far outpacing demand at this rate. There have been news headlines, one from S&P Global, that crude prices could see as low as $55 by the end of the year. Now this isn't me making that prediction. These are sophisticated funds, a well-established name in the industry that are telling you this. All right, it's not just some kid on the internet. They are saying $55 a barrel by the end of the year. Now, what does that look like from where we are now? It looks like this. Top line, we have our current prices, and the bottom dash line is the gap down to 55. Now, this is great for countries that import a lot of oil. It means cheaper barrels across the board for them. However, a country like Canada, who exports and produces a lot of oil, this isn't the best situation for a country like us right now, especially because Canada is very over-reliant on its energy sector when it comes to exports. With a country like Canada that exports a lot of oil, produces a lot of oil, and relies heavily on it, it's a no-brainer that this predicted drop in oil price will have a negative impact on Canada's economy. Why? Well, when we export oil, other people are buying it from us, and we receive income from that exchange. And right now, current GDP is priced around the current oil pricing, and it's been pretty stable for the last quarter, but a $10 drop is very significant. So if we take current GDP prints, which actually contracted in Q2, still waiting on Q3 print. However, if we take that into consideration and our over-reliance on the energy sector as our exports, and this predicted crash in pricing, well, we can infer, putting two and two together, that this will have a negative effect on our GDP and in turn on the loonie. It seems, on a positive note, if there are conforms to certain climate agendas, then potentially caps will be removed, which can be a benefit. There are still some negative sides of this equation that need to be pointed out. And it comes back to our over-reliance on the US as our main trading partner. Trading with the US, exporting our oil to them, effectively keeps us stuck in a currency flow and capital flow that is slowly being abandoned by the rest of the world, meaning settlement in US dollar. That is one. And in my research, I've found out that Canada usually sells our oil at a discount. Now, please feel free to fact check me, but this is what I've come to find in my research. And that discount is often $10 to $20 off spot, which is insane. So not only are we barring ourselves into capital flows where the currency we settle in is slowly being abandoned by the rest of the world, but we're selling our barrels $10 to $20 below market price. So if crude does decide to drop to 55 a barrel by the end of the year, that means Canada, us as a country, we could be selling $35 barrels. What is that going to do to our GDP? Yes, we have the potential for Alberta, for that cap to be removed in Alberta, if compliance is made. However, if that compliance is not met and we begin selling $35 barrels, well, yes, our GDP is going to take a hit. And then, yes, our government will have to subsidize with more fiscal spending. And then, yes, that feedback loop comes back into the loonie in a negative way. Also, energy prices make up a huge amount of our CPI. Now, when it comes to the Bank of Canada, there are two mandates: unemployment and inflation, right? So when inflation is quote unquote under control, their goal then is to help lower unemployment. However, right now, the Bank of Canada, we're stuck in an awkward situation. We're stuck in a situation where 3% inflation is becoming the normal, and they are going to have to accept that as a reality in order to tackle this 7% unemployment. However, now, if crude decides to nuke to 55 a barrel, that will soften the energy side of CPI. And if that happens, well then, that is a clear signal for the Bank of Canada to cut rates even lower. In our last video, we just saw TD, one of the biggest banks in America, predicts that rates will come lower and will stay low until 2027. So guys, if 55 a barrel happens, energy sectors of our CPI will soften and rates will be cut and the loonie will be hurt negatively. However, we also need to consider that Canada being stuck in capital flow with USD as settlement is becoming more and more of an issue regardless of what we're exporting to them. The world is ditching USD for neutral reserve assets, while fiat, like the CAD, like our precious loonie, is falling in value. We now have the choice to exit the system. It's only a matter of education and taking the first steps. If you guys enjoyed this video, hit that like button, drop a comment down below. Make sure to hit that subscribe button. I will see you guys in the next video.